Good morning, this is Ken Long from Tortoise Capital with a review of the weekend trading report for November 17th, 2012. We have a market that has moved into sideways volatile conditions. It's at 44 out of 100 on the weekly RSI 14, in the middle of neutral. On a 10-day basis, it's oversold with the 10-day NDX at 19 out of 100, coded red. Long-term price relative to the 200-day moving average is red sideways at minus 0.78%, so it's about 1.25% away from entering into the bear. Slope of the 50-day moving average is red bearish at minus 0.30%. ADX has increased to 24.5 as the bearish move strengthens. ATR percentage at 1.40% is volatile. Current holdings in the blended monthly rebalancing, no change until on or about 1 December. ETF2, the theoretical model exposure is reduced to 10%. The model portfolio itself is only 50% exposed. Here's a quick look at the details of the blended monthly rebalancing portfolios. Treasuries, Asia less Japan and Australia at the top, and those are the only three that are on a buy signal compared to their 4-month moving average. In the 26 ETF portfolio, still dominated by cash, gold, emerging markets, bonds, treasuries, Asia less Japan and Australia are the top 5. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days of look back period. The horizontal purple lines are resistance levels that are now price targets. The horizontal red lines represent support levels that have held before. I still show this one at 137-ish, which is coinciding with the 200-day moving average. The black center line is the 30-day regression line, and the black lines forming the channel are the regression channel formed by the maximum excursion from the regression line during the look-back period. And you can see we're in the bottom half of that regression channel now that we're underneath the 200 period moving average, which is the thick red line and the shaded red area, and we're at about 7 or 8% from the swing high. So this is definitely a correction. You can see the 5% and the 10% pullback thresholds. You can see ADX strengthening on this bearish trend. Market has on Williams percent R has been oversold for a while. Jaws of PPO, which opened to the downside 20 days ago, still are pointing the way lower. Although the price action of the last 2 days have caused a little bit of a stability. So we could almost find support around 136 here. To the upside, the targets are 139, which is back to the 10-day moving average and the edge of the river. The Bollinger Band mean at 143, and the top of the channel at 145. Looking at the ETF2 regional report, 9 out of the 10 large indexes are in a cash position based on their 4-month moving average. Only Asia less Japan remains strong. EFA is stronger than SPY, so the globals are better than the U.S. right now. Market sideways volatile. Inside the U.S., it's the S&P, followed by the mid caps, followed by small caps, followed by technology, reacting to the sell-off in Apple. The two strongest sectors remain Europe and Asia less Japan. Two weakest are Latin America and Japan. That's the same story we're seeing on the expanded world market model here. Everything U.S. is below average except mid-cap growth, and then because of the Apple effect, Large cap growth is suffering. Silver and gold continue to do well, as well as treasuries and corporate bonds. Mixed bag in Asia, with China and Japan lagging, but Asia less Japan, Australia, Hong Kong, and India leading the way. Inside the business sectors, consumer discretion and healthcare doing well. Only finance doing well among the leading economic engines here. Still a mixed bag. Top 30 ETFs from the ETF2 database: natural gas, home construction, silver, Hong Kong, U.S. real estate, or actually global real estate minus the U.S. Spain, Wilshire international real estate, emerging markets, sovereign debt, precious metals, Mexico, Italy. The Dow 30, based on the same lens, sorted by the relative strength column. Financials leading the way there with Bank of America and JP Morgan and Travelers. Pulling up the bottom here, as it has for a while, is Hewlett Packard. Intel, DuPont, Microsoft, CAT, all suffering as well. ETF liquidity, you can see the increase in volatility has been helping the VIX for intraday range percentage. All right, we'll move on to the daily report now for Friday. All right, we have some overreaction signals in Asia, less Japan, and Europe. Also channeling for the Euro-Asia blend and Europe. You can see the increase in volatility over the last 6 months. Actually, over the last 60 days. A number of channeling and overreaction signals fired with Johnson & Johnson on a 551W. And all of these on the auto framer test out better than 2-to-1 on a retest of the 10-day high, simply based on their trade location. Looking at the max pains, Microsoft, Hewlett Packard, Intel, Walmart, and United Health among the S&P 100, adding General Dynamics and Apple to the mix. Just about everything in the Dow tests out at better than 2-to-1 on a trade location basis. Have a half a dozen RSI 2 symbols. Microsoft and Walmart look to be interesting, testing out at 7 and 6-to-1 on a reward to risk basis. Walmart has the additional advantage of being a channeling and an overreaction signal. ETFs, the top 30 ETFs, same kind of deal. Everything testing out better than 2-to-1 on retest of the 10-day high. Brazil looks interesting as a 5-day down. And with a 1 on the RSI 2, that's essentially a 2-day washout. That looks promising. Europe looks to be interesting too. It was one of the stronger indexes, and it tests at 3.5-to-1, and then it's both channeling and overreaction. Had an RSI of 2. Market mosaic, you can see this the pain and suffering here in the regression line. The regression line is below its 10-day moving average. It's 2 standard deviations off of the 6-month mean. So that's marking an extreme condition. You can see in the longer time series how far that has fallen. It's been a 3 standard deviation move, essentially. And the percent stretch is now below the last test of the 200-day moving average. You can see that it's actually exceeded that. That's also a little over a 3 standard deviation move down. Slopes of the Z-scores of the slope of the regression lines The 90 is back to just about back to the 0 line, getting ready to flip negative. And the 10 and the 30 well below their channel, and you can see how that translates into pain and suffering on the pure price chart with respect to the river. Treasuries look strong here, have left the channel with both regression lines, and gold may have put in a temporary bottom here at 165 and ready to resume its march upward. Additional reference charts, so I won't read these to you. On the Z-score of the losses or the price performance over the last X days, we're looking at 40, 20, 10, and 5 days of look back. I look at the Z-scores, and at the 10-day loss, for instance, for the S&P is 3.86%. That represents a 1.17 Z-score, so slightly more than one standard deviation lost in the last 10 days. So the Z-scores for the S&P, 0.57, 1.17, 1.44, 1.11. So the 20-day suffering is the greatest, having lost minus 6.5%. More reference charts. And that's everything I want to cover today for the weekend reports. This is a market that still hasn't found its bottom yet. The last 2 days it's tried to put in some support. Rebounds from this location have an opportunity to make 7 or 8% in a short run. But since we're in sideways volatile, I'd be much more inclined to take those on a one-day basis rather than trying to call the bottom as of last Friday. So, this is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.